When I worked on valuations for litigation purposes, my favorite part of the job was always ripping the opposing experts' reports to shreds. I always felt like I was giving the client a little bit of joy because the client always hated the opposing side's experts and attorneys. And this mindset has flowed over into my personal investing, and I just like probing deeper and finding chinks in the armor. So even if you're really bullish on this stock, you should hopefully still be open to hearing a contrarian opinion about it. I mean, the company discloses these risks for a reason. Okay, on to MicroVision. A friend asked me to look at this company, and honestly, I was a little bit surprised by its history. I expected it to be a startup, and at a glance, at its financials, it looks like a startup, and it's actually been around since the mid to late 90s. I wasn't able to do any sort of relative valuation using comps because the company has no real earnings or cash flow, which is a bit strange for a 25-year-old company. So I looked at the chart and you can see this big spike that began in December 2020. A Google search revealed that it had become a meme stock at that time, albeit a lesser known one. You can find a steady stream of social media chatter going back years, but this pop seems connected to the new meme stock phenomenon. If you look at a stock chart covering every year since inception, you see it tells a much different story. Let's see what made it spike back in 2000, 2001. I checked the SEC filings as far back as they would go, and back then, MicroVision was a slightly different company, focused on imaging solutions. They were developing information displays that generate images and information which was then projected onto a viewer's eyes. This was retina scanning technology, and the first product was meant to be a handheld barcode wand scanner. I found that their income statement was similar to today's. In 2000, they lost 26 million on sales of 8.1 million. And like most tech companies at that time, they were constantly selling more stock to fund these losses on the premise that they would one day become profitable. But they never even came close. In 2002, they lost 35 million on 16 million in revenue. By 2007, sales had dropped to 10.5 million, most of it contract revenue, not from selling their own product. By 2010, product sales had increased, but contract revenue collapsed. Total sales were only 4.7 million, and they lost 48 million that year. And they continued selling shares to an accommodating market the entire time. By then, their main product had morphed into a laser pocket projector called the Pico. Going back to the balance sheet as of year-end 2000, you can see the effects of continually funding losses. They have this huge negative retained earnings, a deficit actually, but they still have positive book value because of the share issuances. 20 years later, their 2020 balance sheet looks the exact same. Only now the smart money has stopped buying. Look at their institutional holdings, only 19%. Let's look at CCS for comparison, since I always use CCS as an example. It's a smaller company by market cap and has 89% institutional ownership. You might say, well, what about the 18% that do hold? But that's more inclusion in index funds like Russell 3000 index funds. They have to hold it. Normally, I go much deeper into the financials, so let's take a look at the current financial statements. In 2020, contract revenue is basically gone, and the company lost 14 million on 3 million in revenue. And on a cash flow basis, they lost $16 million. And yep, they're still selling shares to willing buyers. I wonder who their underwriters are. The latest quarter is the same. Contract and product revenue are gone, and they're just earning licensing fees, and everything is down compared to the prior year's quarter. Now they're trying to enter the massive automotive LiDAR market, and their product line actually looks really cool now. On some level, I can see why people might want to continue investing in these products. But in their latest 10K, they disclosed that besides a little royalty income, their new technology couldn't find an OEM customer, and that's why they're putting themselves up for sale. It's not that they're such an attractive acquisition target, it's that selling themselves is plan B. Or is it plan C, D, E, F, G? And the automotive LiDAR market is highly competitive and jam-packed with impressive talent, with financial resources that far eclipse those of MicroVision. When I look back at how MicroVision began, it's like it was created just to suck value out of one fat military contract, though I'm sure at the time they hoped for many more. If you're buying into MicroVision because of the acquisition rumors, that's fine. That's a legitimate mode of investing. But this company has a strange history of acquisition rumors that stretch back years, and they've just happened to keep the company afloat. The company isn't like Waymo, founded by a group of young visionaries. Rather, the company seems to have entered the automotive market opportunistically and seems to lack focus. Anything can happen, but this company seems like it's on life support. Do you want your investing style to be akin to providing life support? Thank you very much for watching. Please remember to like the video and subscribe to the channel. Thank you.